Welcome to our podcast, Growth and Inspire. Today, we're going to talk about tax concerns and opportunities that can help you maximize your refund and reduce tax burdens. Specifically, we'll be addressing tax deductions and tax credits. I'm your host, Bonnie Yam, and our guest is Atilio Calderon. Welcome, Atilio.
Good
Before we start,
morning.
good morning. Yes. Can you
It's a
introduce yourself?
wonderful day today.
It's actually a lot of snow. So thank you for taking this opportunity to share some of your learnings.
Yes, yes. Well, today I want to discuss deductions, credits, and refundable credits, which are three things that every taxpayer should be making sure taking advantage of,
Yeah.
especially the low income worker, right,
Yes.
which receives the higher benefit
Mm-hmm.
from that.
Mm-hmm. Mm-hmm.
And the deductions, what the deductions do, they lower the taxable income, meaning the income that is going to be taxed. That's one objective. The
Like
second,
if I make 200,000, by deduction is 100, then my
will
income to be
reduce it
reported
to
is only,
150, 107.
yes, it will lower because I have my deduction. Mm.
Right. And the credits will lower the tax that you owe,
Mm.
which is the second objective. We don't just want to reduce your taxable income, we also want to reduce the taxes
That you owe.
that you owe. If the tax is $3,000, you want to reduce it to 2,500, 2,000, the most that you can legally, of course. And the third objective is to make sure, or at least try to qualify for refundable credits. Not everyone qualifies. For example, one of them is the child tax credits. It's a refundable credit. And what that means is it is money given to the taxpayer, even if they have no tax liability, they don't receive anything, the government will give you that tax.
Extra money. Yeah.
That's
Yeah.
why it's
Yeah.
called refundable. So you will get it regardless of what.
Okay, wonderful.
Or your tax liability is $2,000 and the refundable tax is 3,000, they'll give you the balance.
Yes,
That's what they,
1,000. Yeah.
right.
Yeah.
So that's what I mean. And it's very important that we look after those three things because it does help.
Yeah, okay. Let me just repeat, okay? Make sure I get the understanding. One is tax deduction, so lower my reportable taxable income. So the lower the income, the lower tax I pay. And the other one is if I had to pay $20,000 taxes, I want credits to lower what I owe to the government. So that's credits. But let's say my I don't really owe any taxes, then I want refundable credits because some of the credits are just get me down to zero. But if I'm not owing any more, then I lose whatever the credits are given to me. But if it's refundable, I won't lose it because I'm going to get cash, even if I owe zero, right?
Right, that's
So
correct.
particularly like what Atio says, if you are on a lower income class and you're not owing much tax, what you really want is refundable tax credits because that will be cash in your pocket. And yeah,
Yes.
so we're going to be talking a little bit more about that. All right,
Now,
so
go ahead.
next is, you want to go? Okay, so let's continue on. A lot of people ask about standard deduction and itemized deductions. What's the difference, and which one should I use?
Right. There is a lot of confusion on this part because not everyone understands the difference between itemized and standards. What many people knows for itemized, they say the expense list. Okay, that's one way to be called a expense list,
Expenses.
which is that it's an expense list that you use to reduce your tax liability.
Mm.
And the standard deduction is a number that the IRS give you as a deduction as a credit depending on your status. The single gets one standard deduction. The married filing joint gets a different standard deduction. Head of household, it's depending on your status, that's gonna be the standard deduction. If you have no expenses, no itemized expenses, that's the deduction that you will report on your taxes, the standard. The single 14,600. The married filing jointly is 29,200. However, we had to also make sure that if we have itemized expenses, medical insurance, income taxes on the state, mortgage interest, real estate taxes, plus any other miscellaneous, the total deductible, not the total expense, but the total deductible must be greater than 29,200 for the married filing joint. If it's less than that, then you will be using the standard deduction.
Right.
So we have to be sure we follow that. Otherwise, the return is going to be recalculated and they're going to be telling you, I'm sorry, you're supposed to get this. Or instead of a refund, you will be sent a bill. So we got to be careful with that.
Yeah. So actually, for people who are not really following the paperwork, don't have a lot of deductions, then maybe just do the standard. It's easy. You don't have to submit any paperwork, right? So if I'm single, I get 14,600. If I'm married, file jointly, 29,200. Head of household, 21,900. So, but if I know that I probably have mortgage, interest, I have lots of other expenses, and I think I'm going to be able to exceed that threshold that you share, then all right, so let's do the calculations.
The key here is the homeowner.
Homeowner, right? The
If
mortgage
you're a
interest.
homeowner, you pay property taxes, and the property taxes, at least where I am in Nassau County, New York, property taxes are higher than $1,000, which is the cap. That's the cap for taxes. So if somebody who lives here pays $13,000, also already over the cap, yes, it is deductible. Then you add to that your
mortgage interest.
A mortgage interest. So you have a mortgage, you're paying interest, and that is deductible if that is your main property or your household. Yeah, it's 100% deductible. So that's the key.
So basically, if somebody is owning a house and paying real estate tax, mortgage interest, then take a look at it because most likely your deductions are going to be higher than the standard. That's a little trick, right? Okay, great.
Yes,
Wonderful.
yes.
Yeah, okay.
And
should we talk about another topic? So what about some popular tax credits and deductions? What are the ones that people
there
look at
is
all
the credit that everyone looks for, and is the first thing that people wants to know if they qualify for is the earned income credit, the child tax credits, the additional child tax credit, and then dependent care expenses, which is normally called babysitters, okay, or the child care facilities. Those are very important because those are for everyone who has a child care expense, meaning I take my kid to a child care institution and I pay, say, $1,000 a month. 3 years is $12,000. I just gotta make sure that I do qualify because there is an income
limit.
ceiling. If we go past that ceiling, then the deduction is not allowed. So in the status, it's important, but not as much as the income. It is important for the child tax credits, or there is another one, the American Opportunity Tax Credit, which is for students.
Yes.
American Opportunity and the Lifetime Learning Credit. That's for students. You're into college. You wanna make sure you qualify for either of those two. And the American Opportunity is for the first 4 years in college, in a senior college. Once you pass that level, it's gonna be the Lifetime Learning Credit.
That's right.
When you get into your master's degrees, your doctorate, and all that, you wanna have that high-end degree. That's where you deduct it. there are some type of education that will not go there because they are job specific. Your work requires them. Those are reported differently. Those are itemized deductions or on your Schedule A, but these two are for regular students in college.
Mhm. I want to
Uh,
mention that you cannot double count, okay? So if you use
right.
the yeah, money that applied for American Opportunity, you can use it for lifetime learning. So and
Yeah,
I also kind of
it's
know,
either one or the other. The
yes,
first 4 years is the American opportunity. That's it. You cannot apply for the second.
Mhm.
Once you pass the fourth year, then you're gonna go into the lifetime learning.
Lifetime earnings. So yeah,
Yes.
and I also want to say that the American Opportunity Tax Credit are only certain education institutions, like what Tio says, like if it's work related, might not qualify. So a lot of times, like the one way to try to see if it actually qualify is whether it's eligible for student loan.
Yeah,
If
it
it's
has
student
to
loan, then
be
probably yeah, will be
it
a
has to
qualified
be a
institution.
qualified institution. When you're applying for the education, you get a code. That code tells you that is a
Right,
registered
right, right. Yeah,
institution,
so
and they will send you a 1099 T.
to the sense and yes, and so you have a 1099, yeah, to report. So
Okay.
basically, I want to just summarize it. So what the tax is trying to help is people who have kids. We all know it's very expensive to have kids. So you
Yes.
have child tax credit. So each child is like $2,000. And then on top of that, we also know child care is also very expensive. So child care tax credit. So you get two to help you. And then when they go to school, I mean, like, university, very
Right.
expensive.
Right.
Then you get opportunity tax credit, American opportunity tax credit, and then lifetime learning credit. So they try to help as much as possible, but this is like complicated. You need to keep track of your receipts. Like I think Atilio mentioned many, many times. Very, very, very important. Yeah, all the receipts.
Yes. Yes. Yeah. We had to make sure that we are aware of those credits and make sure that we qualify. And if not, well, then we
Yeah,
don't
document
because
the
he has an
institution.
income
Yeah, if it's cash, you have to
limitation.
write it down,
Yeah.
get the receipt,
Yeah.
everything. Otherwise, you can't report
Yes,
it. We
it's
get in trouble
important.
later on.
On the child dependent credits, you have to make sure that you get a receipt
Mhm.
for the expenses for the year. And on that receipt, it must be the address, the name of the institution, and the taxpayer ID, because you need to
Yes.
put that down on Form 2441. It's
Because why?
mandatory.
They need to report the income,
Yes,
right?
because
So,
they need to
so
report the income also. Yes. The
exactly.
same way we pay taxes, they have to pay taxes. Yeah.
Yep, 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 yep.
Yeah.
All right, that's great. Okay, so let's talk about like for lower income earners. Then we talk about that for them, the credits make even a bigger difference because they really need the money. So I know there are many different types of low income earner credits. Can you just go over some of them?
Well, one of them is what is called the savers credit, and that is for those who contribute to a retirement fund, like an IRA, 401k, 403 for those city, state employees, government employees. Uh, and then there is the premium tax credit, which is for those who buy their health
Health
insurance
insurance.
in the market.
Mm-hmm,
And that's an important credit for those people.
mm-hmm.
There is the residential energy credits. If you fix your house, putting in mind energy efficient improvements, you will get a credit for those improvements. And there are several of those, windows, insulation, the solar energy. There is
Yes.
quite a few
Yep.
credits that you can get.
Mm-hmm.
And the savings are substantial.
I think
So
so too.
we have
Yeah.
to look for those.
Yeah. Yeah.
Um, there are some limitations on those credits for home energy credits. And the limitation is at $1,200 for the year. If you if you replace your windows for energy efficient windows, $250 for every door that you replace, energy
Mhm.
efficient, maximum $500 so you can replace two doors. Yes, the front and the back.
Mhm.
$150 for home energy audits. What that means is the energy companies go and audit your home and they see that and they find it that is very efficient. You could be getting $150. So it's good to have those companies audit your home,
Yeah.
make recommendations. So maybe this time you don't get it, but the next time you might.
Mhm.
And
Mhm.
$150 is $150.
Yeah, I think a lot of
Um,
people not
yeah,
aware of that. So when
yeah.
they
And
spend the money,
at the same time, you help yourself with the energy bill.
yes, that's right.
So it's
That's
a
right. Yeah.
double-edged
Mhm.
sword.
So
Right.
the government is encouraging you to be like environmentally conscientious and try to get more into any energy efficient type of appliances, change your windows, whatever, everything, doors, insulation, all that. And this, their credits. And I think a lot of people are not aware of it. So maybe the suppliers are. So and then you need to know how to file and same thing, it can be complicated, but at least like start asking. So if you did some home maintenance, any of the home maintenance expenses, maybe you can get a credit for it. So yeah,
Right. And you wanna make sure that the improvement that you wanna make it's a qualifying expense
exactly.
for
Very
those
important.
credits.
Very
For
important. Yeah.
example, one of those credits is solar heaters. They're energy efficient, the solar panels up in your roof, geothermal heat pumps.
Mm-hmm. Mm-hmm.
Those are qualifiers for the energy credit on your residence. It's
Mm-hmm.
gotta be your main residential place. There are no caps. There's 30% of the cost. So that is big.
Yeah.
So especially on the solar energy, 30%
Mhm.
of your cost there,
It's quite a lot with
it's
annual limits.
it's
With
a
annual limits.
nice credit. So we have
Yeah.
to be sure that we are doing the right thing.
Yep. 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 Well, that's always great to know. Uh-huh.
Yep. And we just gotta make sure that we qualify and that we wanna make those improvements on our primary residence. If it's a secondary residence, we actually do spend some time in that secondary residence, your vacation home, for example. Yeah.
Hmm.
It must be, it cannot be a rental.
Rental home. That's
No,
different. Yeah.
it
Yeah.
must be a
Yeah.
primary or
Primary.
secondary
Yep.
residence.
Hmm.
Yeah.
So I think there's like a lot, that we've covered and we can go on and on and on. But let me just like kind of repeat the most important ones that you need to know. You want to do standard or you want to do it itemized. So if you have a home, if you're paying mortgage, and then there's like real estate tax and you live in a very expensive area, so I think maybe itemized might work. So make sure that you figure it out which ones would work better for you. And then if you are low income, not making a lot of money, you want the earned income tax credit because it can go up to like 7,000 something. It's a credit,
Yes.
so free money. So
Yes.
it all depends on your status, like are you married, how many kids you have. So make sure that you check that out. That's free money to your pocket. And then, of course, the government wants you to save more. So there's savers credit, and then health insurance is expensive. So if you buy it on the marketplace, depending on your income, it might even be free because you might qualify for Medicaid. So everything has a level. So we need to figure that out. And then the other big thing is don't forget, particularly when it really hits you because it's very expensive, the home improvement part. So make sure that the energy efficient equipment that you install qualifies. So if it's an electric vehicle, they will ask you for the VIN number and you type it in, does it qualify or not? And then they actually will tell you immediately, there's some calculators tell you exactly how much credits are you going to get. So we will help you report it and then we'll assist you if you have any of these questions. But the good thing is, yes, it's complicated. The other thing is that you might be eligible, but we need to do a little bit more work, a little bit more research, right?
We are here to help.
Yep. Okay. So I hope, you find this episode helpful. I know there's like always more questions. And to wrap up our podcast on tax credits and deductions, remember that everything is about tax planning, and that can make a big difference in how much tax you can pay. And refundable credits are better than the adjusted credits because even if you don't owe, you're gonna get money back, but every dollar counts. Okay. So at this, let's just say that think about what need to do, how to get started, and then share the knowledge with your friends. And if you have questions, reach out to us. So thank you very much for listening to this episode, and we hope to hear from you again. So see you next time, and happy saving. Thank
Have a
you.
nice day, everyone.